I do think that it's too hard to ignore the ability to softly default on the dollar by revaluing gold. It is one of our only options left. And for those of us who look past even being able to market, guys like James Rickards, who's saying way much higher, maybe 24,000 based upon a metric he has, or Mike Maloney, who says 10,000. 10,000 would give the Treasury general account $2.5 trillion free and clear. 24,000 would give $6 trillion free and clear. But I think politicians might argue, if it gets to that point, that the long-term purchasing power of gold justifies a higher valuation. I don't know, but I do think that it's coming.
In a surprising development, the Federal Reserve recently published a report exploring the potential for gold revaluation, a topic that has traditionally been dismissed as fringe speculation. This report highlights ongoing conversations among central banks worldwide about the possibility of adjusting the official price of gold in response to escalating debt burdens and inflationary pressures. The idea is gaining traction as governments search for tools beyond conventional monetary policy to stabilize their balance sheets and reduce reliance on debt issuance. This renewed focus comes at a time when global fiscal challenges have intensified, making gold's historical role as a store of value and hedge against currency devaluation increasingly relevant in official policy circles. Andy Schectman, a recognized expert in precious metals and CEO of Miles Franklin, has emphasized the significance of this shift. According to Schectman, a meaningful revaluation of gold, whether to $10,000 or even $24,000 per ounce, could release trillions of dollars of latent capital tied up in central bank reserves. This capital infusion would bolster the Treasury's general account, providing governments with additional fiscal flexibility without the immediate need for increased borrowing. Schectman warns that such a move would represent a fundamental challenge to the current monetary system, potentially paving the way for a partial gold backing of currency or new financial instruments that integrate gold into official reserves more prominently. The sharp increase in physical gold deliveries on the COMEX and unusual futures price movements support the view that market participants are beginning to position for a structural change in gold's monetary role. Further complicating the landscape is the implementation of a 10% tariff on all imported gold bars, effective April 2025. Schectman argues this policy could significantly disrupt bullion supply chains and encourage domestic accumulation. Although the administration recently stepped back from a proposed 39% tariff, the remaining 10% duty remains a substantial hurdle for international gold trade. Should the government officially pursue gold revaluation, it would mark the most significant monetary policy shift in decades, with profound implications for investors, currencies, and global financial stability. Now, we present the clips from Andy's interview with Liberty and Finance. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Yeah, you look at the issuance of all the stable coins. To Rafi's point, the issuance of stable coins would really compete with the Wall Street banks, would really start, in my mind, to challenge the mandate of the Fed, one of the mandates, and in the respect that when stablecoins are being created, not just by banks, but by corporations, the backing will be U.S. Treasuries and a one-to-one basis primarily, or real darn close to it, instead of currency being created through lending by the banks. And what this does is it will take reserves out of the Federal Reserve, because these bonds, these treasuries, will be purchased or taken directly from the Fed or the accounts at the Fed, and then deposited into the Treasury general account. In other words, everything goes through the Fed, and so it will go through the Fed. It will pull reserves out and go into the Treasury general account. And really, what that does is it gets us probably much faster to that point that we saw in 2019, where you had about $3 trillion in reserves. And when you dip below that, you get into a liquidity problem. You get into that reverse repo problem. You get into the overnight lending spike problem. There are a lot of very interesting things happening at the Federal Reserve. The appointing of Stephen Murin to the to the spot that it has opened up. The gal that resigned, he's the gentleman who advocates for a weaker dollar, who wants lower interest rates, and is the author of the Mar-a-Lago Accord. So many things happening with the Federal Reserve, not to mention who is going to take the helm who to replace Powell next year, and is it Judy Shelton? Is it Bissent? What is their plan? Is it to devalue the dollar? Is it to do something with gold and revalue it? You just saw the Federal Reserve issue a report right off their website. Go to it and look at it, talking about gold revaluation, how it's been proposed by people not only in the United States but other central banks around the world. What was a fringe theory that I talked with you and others about months ago is now all of a sudden being written about on the Federal Reserve's own website. Certain things that stick out as well. You have Michael Hartnett, who is an analyst at B of A, amazing analyst. You know, Vince Lancy covers him well, and Vince is another smart guy, one of the smartest. But Michael Hartnett is one of these guys you have to read over and over, or have Vince read it for you and kind of translate his lingo. But he just came out the other day and said central banks, in essence, will be forced to revalue their gold reserves because of debt burdens, which is obviously very positive for gold. Michael Hartnett said that. And then you have another one of their analysts, Bank of America, Francisco Blanche, talking about gold revaluation, said, be very bullish for gold, showing it's no longer a barbarous relic, but a key asset for central banks. Now even the biggest central bank of them all is taking a renewed interest in gold. So you have analysts of the B of A talking about this. But this is too hard for the Fed, I think, and the Treasury to ignore in an effort to pay down debt, to fund stimulus, or to infrastructure. Maybe not to issue as many bonds for a while because they'd have enough money in the Treasury general account, or, to your point, support a new currency framework, a new partial gold backing, or to Judy's point, a Treasury-backed, a gold-backed Treasury. And for those of us who say, well, like James Rickards, it's funny because I did an interview today, done again with Alistair and Jesse Day. Jesse asked Alistair and I on, and he doesn't think it'll happen, that gold will be revalued. And I said to him, I really appreciate your insight. I disagree. I say, when I'm on with Dunnigan, I tell him you're the smartest guy in the industry, and he is. But I do disagree. I do think that it's too hard to ignore the ability to softly default on the dollar by revaluing gold. It is one of our only options left. And for those of us who look past even being able to market, guys like James Rickards, who's saying way much higher, maybe 24,000 based upon a metric he has, or Mike Maloney, who says 10,000. 10,000 would give the Treasury general account $2.5 trillion free and clear. 24,000 would give $6 trillion free and clear. But I think politicians might argue, if it gets to that point, that the long-term purchasing power of gold justifies a higher valuation. I don't know, but I do think that it's coming. There's been a lot of talk also about the tariffs. One of the things that I saw last Thursday night, and again, I've never seen before in my going on 36 years in this industry. So I'm out to dinner with some people, one of which is someone who I work with, and he says, do you see futures? They're at $3,500, and I look at my phone, I look at our website, I'm like, that can't be because spot's $3,400. He says, no, they're $3,500. I'm like, can't be. And lo and behold, I looked at the CME website, and yeah, they were at $3,505 or whatever, even higher. I've never seen that, to my memory, where on one announcement that the futures price dislocated by $100 an ounce from the current spot price. And certainly putting a 39% tariff on gold bars would have been enough to certainly do that. Now, they have backed away from that to a degree. One thing that people who are covering this story are missing is still the 10% tariff on all gold bars, regardless. In fact, I think I have it on my phone here. I was just reading it. Regardless of, Yeah, as of April 5th, 2025, an executive order added a 10% additional tariff on all imported gold bars, regardless of country. So that's $1 million worth of gold bars imported would add $100,000 extra on tariffs. Now, it does exclude the bars that have come in under this 39% tariff. Have no duty. Now, they have backed off on that and said the customs had spoken out of turn. So, no, they're not going to be tariff 39%. But that 10% tariff alone, if you know that these refineries and this industry works on fractions of a percent, is ridiculous. And will make very quickly, these banks who are shorting naked think twice about doing this. And so I'd also like to say that even though they've backed off of the 39% and all of a sudden people are forgetting about this extra 10%, which I guarantee you is part of the reason what we're seeing in COMEX, which I'll get to in a moment, I think it really goes to show how quickly things can distort prices and trade flows, with gold's plumbing being as sensitive as it is. Like bang, boom, up $100. Whoa, I've never seen that before. One of the things that I've noticed a lot about the deliveries into COMEX is just how they keep ramping higher. And it's something that is very strange to me because these are things that we would never see now.
Recent activity on the COMEX gold futures market has revealed an unprecedented shift in the behavior of market participants, signaling a deeper undercurrent beneath the surface of financial markets. Within the first 3 days of the delivery notice period, more than 20,000 gold contracts, representing over 2 million ounces, were submitted for physical settlement. Remarkably, unlike typical cycles where only a small fraction of contracts convert to delivery, every single contract during this period was stood for delivery in full. This translated to nearly $7 billion worth of gold physically moving out of COMEX vaults, a phenomenon rarely seen in the modern era. Similarly, silver has experienced outsized withdrawals, with net outflows significantly exceeding inflows in recent days. Industry experts like Andy Schectman emphasize that such large-scale physical metal accumulation by key market players is a critical signal, often overlooked by mainstream financial media. This movement toward physical metals is happening against a backdrop of contrasting investor behavior. While retail investors pour into equities with record margin debt and option trading volumes, institutional insiders and hedge funds are divesting their stock holdings at unprecedented rates. Andy Schectman and other market watchers highlight this divergence, noting how well-informed players are shifting away from speculative assets toward tangible stores of value, like gold and silver. The outsized delivery volumes and metal withdrawals from COMEX suggest that these savvy investors are preparing for potential volatility and shifts in monetary policy, underscoring the importance of tracking physical market flows and insider actions rather than relying solely on headline market trends.
That less than 1% of contracts ever stood for delivery. Now, I used to say that way back when we started talking about all the deliveries on COMEX. In 2020, I was talking about this with you, and I'd say, look, forever, 1% or less stand for delivery. And I mentioned to you last week how just through the first 3 days, we saw 20,160 contracts post for first day settlement. And of those 20,160, which is 2,160,000 ounces, every single one of them stood for delivery, 100%. Now that's really unusual, like way unusual. And in 3 days, the first 3 days of the delivery notice, $7 billion worth of gold stood for delivery. And most has actually been withdrawn off of COMEX. Now I got at the same time, and I want to give credit, I try and always give credit to people like Vince Lancy and Alistair, because this whole community does so much work. And it's hard to do it all on your own. And I rely upon 3, 4, 5 hours a day of reading. And I find so many people, and I try to quote them. This is someone, I don't know who it is, but I notice that we follow each other now on Twitter. His name is PM, his or her name, PM as in precious metals bug. And PM Bug said, I looked at the totals for COMEX daily delivery stock reports for the last few days. You can see that the received and withdrawn numbers are 10 times the net change. Okay, I could show you the table. But what I want you to understand is that August 1st, must have been a Friday, August 4th, 5th, 6th, and 7th. Those are the days that are in this table. And what it shows as is that for silver, okay, for silver, the COMEX received 1,721,192.540 ounces in bars into the COMEX on those 5 days. 1,721,192.540. But we saw leave the COMEX withdrawn over those same 5 days 1,890,316.820. So more than all of the silver that was deposited in those first 5 days, which in and of itself is crazy, seeing all of these deliveries, all of it plus another 170,000 ounces left the COMEX. One of the things that's really unusual, Dunnigan, is this acceleration. It's crazy enough to see the deliveries. It's really crazy to see the number of contracts posted for settlement stand for delivery when so many of these contracts would roll over or cash settle, not stand for delivery. And when you see in 3 days, $7 billion worth, 20,150 or 60 contracts, all of them stand for delivery, it should start to marinate in your brain that something much, much, much bigger here is happening. And look, so I mean, what you're basically seeing is that not only are players wanting to keep their metal at COMEX vaults or bring it here from wherever it's coming from, they're also withdrawing a massive amount, in fact, in this case, more than was delivered. To me, that is a massive sign of the times, and you have to wonder who's behind all of this. I don't know. I guess that it's interesting that there's zero talk of this on the mainstream business media. Those are the big things to me. We could talk about the acceleration of M2 and what that typically means. One other thing, I guess, that is worth mentioning, I talked with you about how we have record margin debt, we have record by the public, we have record participation in the equity markets by the public, greater than that of the dot-com bubble. At the same time, we have all of the insider selling, like huge, the owners, the business insiders, but also the institutionals, the hedge funds. They've been selling $2 to $4 billion a week since June. And I talked about Bezos selling $6 billion in Amazon since June. Anyways, one other thing to add to that is you also have record option play by the public. So you have, when you talk about what could possibly go wrong, you have record involvement in options by the retail public, record margin debt by the public, over $1 trillion, record all-time, and record participation as the insiders are going the other way. And then you see deliveries, like I'm mentioning, with actually outflows out of the COMEX. You're talking so sophisticated, and who the hell and where the hell is it going? Who's taking it, and how do you take semi-trucks worth of metal out of the COMEX? Where is it going? But every day this is going on. Every month this is going on with gold and silver. And the public has very little exposure to it. So the public is all in on leverage in equities, as the institutionals and the insiders are going that way. And their institutionals and whoever the hell is sophisticated enough to do this on COMEX is taking delivery and deliveries and offloading amounts that I've never seen in 36 years. No one has, while they're, the public has nothing in equity, in commodities. And what could possibly go wrong? I think people need to think about the little man rule, the art of war, misdirection. This is how the big money always wins, and the herd always gets led to slaughter. It's the few that, can do things out on that cold branch with the wind blowing against you and no one supporting you, because you know in your heart that this is not the path to salvation, following the herd. it's a tough thing to do right now, but instead of following the herd, why don't you follow the insiders? You don't have to listen to what everyone is doing. Just look what the insiders are doing, and that should be, I think, a far better indication of where success will be than the herd, who is pushing the narrative at all-time highs and all-time overvaluations. Historically, I don't know. For me, I'll take the road less traveled, but traveled by people who are closest to the information, at least if it were me.
A formal revaluation of gold would mark a structural inflection point in the global financial system, triggering a broad realignment of asset valuations, monetary policy frameworks, and sovereign balance sheets. By elevating gold's official value, central banks would effectively reset the base layer of the monetary architecture, allowing nations to strengthen their reserves without issuing new debt. This shift likely reduces confidence in fiat currencies as the sole store of value, driving capital toward tangible, finite assets with intrinsic properties. Financial institutions and institutional investors would be compelled to reallocate portfolios, hedge against currency dilution, and reassess counterparty risk in light of gold's enhanced monetary role. As gold assumes greater strategic importance, trade settlement practices could evolve toward asset-backed mechanisms, limiting unchecked credit creation and introducing a layer of restraint to global liquidity flows. How would a potential revaluation of gold impact global financial stability and the future of currency markets? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.